We are going to take a really good look at Medical Properties Trust today, MPW. They've been on a continual slide over the last year and a half, with the price reaching really lows of about $7. But I think we're beginning to see them turn a corner. Today we're going to look at some of the really positive news coming up, but we're also going to go over two key things that I'm keeping my eyes on, and I'm going to let you know what I'm monitoring, so stick around until the end. So here we are in fast graphs. As we can see, since the Great Financial Crisis, at a price to AFFO, which is like the price to earnings ratio, of about 3.2, it has reached at times about 18 or 20 almost, both in 2013 and 2020. But recently, since the end of 2021, throughout 2022, and now into 2023, we've seen this continual downward slide in stock prices. Now, in that time, we've also seen quite a steep drop here in AFFO for the 2023 year, and that is also bringing us close to this white line here representing the dividend payments. Now, because Medical Properties Trust is a REIT, a real estate investment trust, I'm using the adjusted funds from operation as a reasonable proxy for basically like the earnings for the company. Now here we have a look at the Analyst's accuracy. So this is called the Analyst scorecard on fast graphs. Now the key thing here is yellow means that the Analysts are getting it right, plus or minus 10%, 1 year forward, or right 2 year forward, plus or minus 20%. And they're getting it 2 years forward at about 92% of the time, and 1 year forward about 3/4 of the time. Now when you look at where these issues lie, a lot of it's the 2019 year, which is a bit of an aberration. And with the 2 year forward analyst estimates, we're looking at a pretty reasonable track record, I think. Although, as it notes, this is plus or minus 20% here for 2 years forward. So generally, I think we can do a reasonably good job relying on these analyst estimates. Now, when we begin to think about the forecasting calculations, I'm going to switch this to the normal multiple, and I'm going to assume it can return to about a 15 times multiple, which is what it's exhibited in the past over the last 5 years on average. And if it returns to this multiple by the end of 2025, we're talking about 143% total rate of return, which is equivalent to about 42.6% annualized rate of return, which is reasonable. So that's what I like to see as a really good upside potential there. Now, the big questions, I think, whether or not they can actually pull this off and whether or not the prices are going to return to these levels. And there's a couple of key factors to think about here. Number one, the dividend yield is currently 12.5%, which is a very nice, comfortable dividend yield. The long-term debt to capital ratio is about 52%, which isn't too bad. But the S&P credit rating is only a double B at the moment, which is lower than I generally like to see. Now, a couple of the key elements here. Now, Fast Graphs has an absolutely fantastic element here that lets us see how the estimates have been changing. So 6 months ago, say for 2023, the end of 2023 estimates were $1.40 for the adjusted funds from operation. Now they're $1.21. And we can sort of see that they, over those preceding, 6 months, the estimates have been evaluated and adjusted downwards by the analysts. Now, as we see this, it's dropped also out to 2024, but not as much as it did for the end of 2023. So we're expecting a small recovery here in AFFO, and then again a small decrease into the 2025 year. So here we are in the investor update for June 2023. And there's quite a few important, interesting slides here, and I'm just going to be scrolling through these fairly quickly. Probably the biggest point here is what they call this very substantial disconnect here, an unwarranted valuation disconnect. Now, one of the most important slides is this slide here, which is very much near the start, which says there's an unwarranted valuation disconnect in Medical Properties Trust. Now, they're saying this isn't caused by changes in the business model or execution. They're basically saying, hey, look, the fundamentals here are solid. We're sticking to the business plan. We're executing well. The business model has not changed. What they're saying is essentially the prices have become disconnected from the value. As you can see here as well, the NAV, net asset value premium discount, has shot down to here, down to 41%. So basically they're saying, hey, look, if we could sort of liquidate all of these assets, the net asset value would actually be substantially higher than the actual value of the company if we, looked at the total value of all the shares outstanding. Now, what that would mean is either they've got a completely out of touch, perhaps, valuation for the NAV, which I don't think is correct, but it basically means that the prices at the moment are much, much, much lower than their net asset value. Now, as they say as well here, there's a whole host of things that have not changed. So they still invest in real hospital assets. Their physical quality is good, demographics, so they look at carefully, they look at competition in the region, and they also look at the financials. So they're not just buying assets without due diligence or care. They continue to make their investments very, very carefully. Now, as they said, look, the business model has not changed, and the business model continues to perform. So when we begin to look at this, here is the trailing 12 months EBIT coverage statistics, and it's been pretty stable over the last couple of years now, and it's the highest amongst the healthcare REIT triple net lease portfolios. And we can see here that the inflation and interest rates, even though there's year-on-year growth in the CPI and the year-on-year increase here on the Treasury yield, we can sort of see that this has all been accounted for within the business plan. Now, there's a whole load of elements here that they're basically trying to debunk some of the issues here from the marketplace, some of the major false claims here, and the facts here. Now, I don't want to get into too many of these. I think a lot of the challenges here is that the company's demonstrated that they're able to manage, that they're executing well. There are some challenges with what they've been doing, and we'll get into that. And I think one of the biggest issues here has been relating to the debt that they've taken on. So their investments have held their value, so they've actually engaged in a number of transactions, and they're basically, if you look at this, the original cost basis versus the value as they sell them on the marketplace, and we're basically seeing that the assets have held their value, which is good to see. So those net asset values seem to be somewhat correlated to market values here, which is good as well. For me, I think this is one of their weakest points, is the debt maturities. And they've got some debt maturities coming up, and I think the biggest ones here are coming up in 2026, where they've got a Great British Pound, US dollar, and Euro notes all coming due, as well as the 2026 credit facility revolver. Now, the credit facility revolver, I more or less anticipate that won't be a big problem. They should be able to roll with that quite happily, but I think there are these repayments coming through that they do need to think about. They've noted 2023, 2024, they've got repayment is anticipated from property sales and cash reserves. So I think that's looking good. The AUD bank loan here in 2024, they're expecting the full payment from the recent sale of the Australian assets this year. And so basically, up until the end of 2024, things should be okay. But as I say, look, I'm a little bit hesitant and worried about 2026, and also then when we get into 2027 with $1.4 million in US notes, which is quite a substantial sum. I've turned it to the ticker terminal to get the lowdown on some of these values and try and get a really better understanding of what's been going on. So first of all, the book value per share, since about 2011, it has been pretty much steadily increasing, although after here about 2019, 2020, we can see those increases in book value per share becoming more muted, with only very minor increases provided as suggested by the analysts ahead. When we begin to look at the adjusted FFO, now this is the total adjusted funds from operation. We can see again very, very strong growth here into 2020, 2021, 2022 growth, and then the big drop here in 2023. Now, if you just look at it on the face of it, that's probably one of the major drivers also of the recent prices, is this adjusted funds from operations drop here. Now, it's not just the total adjusted funds from operation that's dropping, it's also the adjusted funds from operation per share. Now here we can see one of the key points with REITs is the funds AFFO per share have been increasing, but relatively far less than the actual overall AFFO. And the reason, when you think about that, is they're essentially diluting existing shareholders in the REIT by issuing new shares in a way that they can then fund their new acquisitions. However, we're seeing this drop here into 2023, quite a substantial drop. We saw that from fast graphs, and then some fairly muted sideways movement in AFFO per share, and then potentially a drop in 2026, 2027. Now, just be careful here as well. There's not that many analysts providing these estimates. So if I'm scrolling down here as well, I can see that there's only 2 analysts providing estimates out that far and one into 2027. So realistically, 2024 has 7 analysts covering it. 2025 has 4 analysts covering it. So I think you need to take that into account. Now, one last element here as well is the interest expense. So as I said, I'm a bit concerned about their debt, and the debt's increased, or the interest expense has increased in 2020 to 2021, and analysts are expecting it to hold pretty much steady at quite a high expense till the end of 2025. Now, bearing in mind what we noted before in one of the investor presentation slides was they've been busy selling some assets, particularly say in Australia, and that has reduced the interest expense. Now, the key thing about selling those assets, and if they sell further assets to reduce this interest expense by retiring some of that debt, the sale of those assets does decrease debt. It does hold the interest expenses stable, but of course, when we flip that around, the sale of those assets is also going to decrease the adjusted funds from operations. Now, remembering at the same time that they're not actually changing the number of shares outstanding, and so we can see potentially some pretty substantial declines here in the adjusted funds from operation per share as they begin to sell assets to retire some of that debt. And so I think this is the key issue that the company is going to be grappling with over the near term. So as I wrap this up, look, I think they've made some pretty good progress tackling that debt. Yes, they've sold some assets, they've paid down some of that debt, but they've also been actually paying off some of that debt as well without refinancing it at much higher rates, which I think would have been fairly substantially problematic. A lot of the remaining debt is largely fixed, and that's also of benefit to them. Now, the market is still pretty much largely open for business. They're still looking for transactions. I think there are some very small purchases in this fiscal year as well. And so the costs of doing business now are much higher and different to the costs of doing business for them a couple of years ago when they were looking for deals, but clearly they can still find deals. Now, I think there's some really important points here. They've been dragged down with some tenant troubles in the past. The recent announcements around Prospect that they've recapitalised, I think that adds safety to the dividend, and we're anticipating some of those Prospect payments to come through in September, with some of the full payments then beginning in early 2024, and that should give us a bit more security as well. Dividend cuts, yes, they are possible. As we've transitioned from 2022 down to 2023, we can see the AFFO has dropped substantially, while the dividends have been held constant, and we can see that this pushes us to an estimated payout ratio by the end of the year of 96%, which is very, very, very tight, my friends. Now, as I noted, if Prospect continues or does regain the ability to keep on paying full rent, that's going to boost the AFFO here in 2024, and I think that's really what is driving this increase here, and that should put the payout ratio at a much more reasonable 90%, still higher than I'd like to see. Still substantially higher than it was here in 2022 at just over 81%. And so I think the dividend cut is still a potential threat. One of the big questions is how big would it have to be? I mean, even at this price, it's still paying a dividend yield of 12.5%. So even a reasonable dividend cut would still leave us with a reasonable dividend yield, and it would probably bring some stability to the company. I don't think that's going to happen. It looks like they're going to be able to squeak through and manage this, and I'll be watching them. My key things that I will be watching is, can they pay down some of that debt, and can they begin to bring their tenants back to full rent payments in the 2024 and the end of 2023 financial years here. What do you think? Is this a good investment that's in your portfolio? Is it one where you think there's a good long-term upside opportunity? For me, I'm hanging this as a somewhat speculative buy. Is a part of my portfolio. I had some put calls that I wrote earlier, and because of that, I've got a number of shares in my portfolio. Now, I've compensated that a little bit with also writing some covered calls once the puts were actually allocated to me. I've got a reasonable shareholding now, and it does bring in quite a bit of dividend yield. But is this a position I want to be a major part of my portfolio long term? Possibly not. And I think there'll be quite a few people who've been buying here at these lower prices who will be thinking the same thing. What do you think? Hit me up in the comments below. Let me know.